Hey guys, Freaky Finance here. Just in the process of taking down Halloween. Just a big deal in this household. And I was like, you know what, I'm going to jump on and do Norwegian Cruise Line. There's a lot of companies I could do this week. There's a lot of things that sold off on earnings. And no one was there on the bid. So things shot down like 20%. And it was you were almost expecting it by Friday. Anyway, Norwegian was one that reported. It didn't go down 20. Well, it did 15 and then maybe another 5 after. We're going to jump into it. It's similar to similar but different to what we talked with Carnival Cruise Line, but most people understand the product, so that makes it easy to start the video. So basically cruises, and they make money on the tickets and the food. And they actually make more profit on the food and like the excursions and stuff like that, the value add when you're on the ship as a captive customer versus the tickets themselves, which are usually just to cover the cost of everything that goes on with the operations of the cruise line. Norwegian has 3 brands, so they have their big one, Norwegian Cruise Line, then they also have Oceania and Regent, and basically you're slowly going upscale as you go up these. That's the idea. How I'd view it here is the summary of brand targeting from AI. So Norwegian, contemporary, families, couples, groups, freestyle cruising, flexibility, entertainment. Oceania, upper premium, foodies, destination explorers. And then ultra luxury is the Regent. So high net worth travelers. That's the idea behind the structure and the brands that they have. There's some metrics that we should get into. Capacity, your total inventory. It's capacity days, not just the number of ships. So it's the berths available for sale, the number of cruise days in a period. And this is a good example here of say if you're a hotel room, your capacity for 30 days and 100 rooms, even though you have 100 rooms, it's 3,000 room nights. Anyway, for when you hear berth, which they talk about quite a bit, if you listen to the calls or even in their presentations, a berth is a bed and their capacity is total number of beds. Occupancy, you're also going to see high occupancy over 100%. And AI here again is good. We're going to see me fight with AI in a second, but at the first part for like normal, just like conjecture, very basic, it's pretty good at explaining things. So occupancy is a key detail. Cruise capacity is calculated assuming 2 people per cabin. When a third or fourth passenger, like children or friends, the occupancy goes up above 100%. So that's why. So the average spend per day is also very important. So AI says on average $430 per passenger per day. The ticket revenue is a large part of that, the sticker price. And then you have the onboard and other revenue per day. So that's your alcohol, your casino gambling, your shore excursions, your specialty dining, and all the extra things they try to get you to pay for, either while you're on the ship or before you get on the ship. Just add-ons to your package, basically. Net yield is the most important metric. It's the true pricing power. It's like how much revenue did NCL, so the company, generate for every bed it had for sale, even the empty ones. So that's super important. And the net cruise cost, ex fuel, is also the cost that they can control. So that's also something that we looked at. We talked kind of about how cruise, especially for Carnival, we saw the demand still go up. The booking curve was good visibility, and we knew oil prices were likely to go down. So we basically just took that spread and made a decent return on Carnival. And some of the proceeds have actually tucked back into Norwegian at this point. That's not to say one's superior to the other. They're different beasts at specific points in time. So anyway, like Carnival in my mind was an easier setup. This one I still might have time to slowly continue to add. I should share that I do own this one. I did start a position this week when I saw it shoot down. I was like, I got to start buying some stuff because things were just shooting down like crazy. So bought some Norwegian down here. Started adding to Microsoft again, oddly enough. Bought some Duolingo. What else? Bought a little bit more Salesforce. These are just in the C's. But anyway, you get the gist. I do own Norwegian. And it's not yet a full-size position, but it's getting there. Before we jump to the annuals, I do want to say when we go through the numbers, the profit margin on onboard spending like excursions is significantly and dramatically higher. That's the AI's terms. And you can see sometimes it has a lot of conviction when it shouldn't. This time it's fairly accurate. The sticker price that's the low margin item in its eyes. It's basically to cover the cost of running the cruise ship. So that's your ticket price. So that's the fuel. It's massive and volatile. It is a big deal. Cruise salaries also very important. Basic food and beverage, port fees and taxes, and then commissions. So to travel agent or booking website that they pay. And then you have the ship depreciation and interest. And this is a CapEx heavy model. So it's different than other companies that we've talked about specifically when we're talking about software. It's the opposite, right? Airbnb, Pinterest, very little CapEx. Cruise lines, the ships cost a lot of money. So that's something you're also going to see. It shows up very obvious when we go through the numbers, especially what happened to it during COVID. In terms of the last quarter, it was a beat and raise. In my mind, the guide was fine. It was an overreaction because the leverage started to not go down anymore, I think. And this is an important factor. The balance sheet always matters, and that's something I wish people in undergrad were taught more, the balance sheet matters. It's going to act like an anchor. So in Norwegian's case, it had to take on a lot of debt. We're going to see this in the numbers. It had to take on a lot of debt and issue shares during COVID at higher interest rates. It was not a good time. And basically, Norwegian's been paying off this debt relatively, I'd say, successfully. And it's also been growing well into the debt. However, every now and then you're going to have a big ship come online, and that's going to shoot up the net debt. And so that's what happened. Now, there's other things that happened in the quarter we're going to talk about, but I thought that was very interesting. So that's worth pointing out. The balance sheet always matters, and usually it acts like an anchor. So when you see the valuations, they look like, oh, Norwegian's way cheaper than it was pre-COVID. Part of that, a large part of it, is the debt level. We're going to talk about that when we go through the valuations. The difference between the PE multiple and the EV to EBITDA multiple is totally stark. So, and this is a great example of this. So anyway, you can see the margins expanding. In terms of the operations of the business, if it didn't have COVID, the business is far superior to what it was even in 2019. So if the debt level was fine, we'd probably be at a higher price than when we were in 2019. So that's something to also think about in your head. Now they still have to chew through a lot of debt, and that's why I think I have time to slowly add as things happen. But there's other reasons why I like the cruise lines over hotels, because they took a lot less price. We're going to go into that as well. So anyway, you can see the debt slowly go back down from 7.3 times to 5.3. But you can see in the latest quarter, it stopped going down and started going back up again, which is not actually in line with what the management's saying. They're saying deleverage is going to keep happening. But it didn't. And then you also had an interest expense show up, which we're going to talk about. The AI totally got wrong. And I was like, yeah, anyway, we'll talk about that in a second. In terms of the inflation, you can see they've been managing their costs very well. They've only had 0.75% cost inflation year over year, not including the fuel volatility. So, and they're expecting 3% inflation in 2026. So their inflation hasn't been as high, I believe, relative to other areas. And I think part of that's just the diversified footprint. There's different areas, different ports. It hasn't been not all the economies of the world did what America did, right? They didn't all just print money, shut down, give people money, and incur a lot of inflation that probably could have been avoided, or at least more mitigated. And then they were slow to increase interest rates, as we know. So what I'm trying to say is the price pressures on these cruise lines are not as high as the other places that they compete with. So the average dollar for a hotel has gone up a lot more than the average cruise line price. And so we're seeing this shift. And I think this is actually something that's going to continue, as I do believe, unlike what I'm seeing headlines that cruises may not be able to take as much price as they have. I say they can take price because they haven't taken as much price as everything else over the last few years. So that's a reason why I like this area right now. We already talked 3 brands. Here you can see in terms of the performance, the business is getting better. It's guiding to continue to get better, right? We're going from $210 in EPS expected for this year to $245, which is nice when you're only at $18 a share, right? So you're not asking for a lot, and you're seeing the nice deleverage. So mid-4 in 2026, which will be nice too. In terms of the reason why the debt is lumpy, so why it shot back up, is because we have all these ships coming online. And this is also different from Carnival. Carnival had no new capacity coming online for a while, which made it a lot easier. I could just bare bones it. And it made the idea in my head a lot simpler, right? We made about 60% on that trade, and I still own it because I still believe in it. It's just, it needs to, in my mind, it's competitive with Norwegian, right? So it's just an interesting time for cruise lines. But anyway, you can see Norwegian has a lot of ships coming online, which does make the debt, like the pay down, lumpy, but it also means the growth rate's higher because there's more and more ships coming online. But it is CapEx heavy. So you're seeing that in the free cash flow numbers and in the balance sheet being slower to deleverage than it otherwise would, right? If you didn't have these ships coming online, you'd be deleveraging a lot faster, but your growth rate would also be a lot slower, right? Because these are all going to start generating revenue. In terms of the deployment, this is also important to know where they do a lot of their business. So Caribbean has traditionally been a lot of their business, 40%. It's actually up 10% versus 2025. And Caribbean's also seen as lower margin than other, say, more luxurious places like Europe for their average customer. So that's also something that they're like, oh, we think you're going to take less price because your Caribbean's going up 10 and Europe's going down 5 year over year. So that's another thing to think about. Is where do these guys travel? Though I also think Caribbean is one of the cheapest places to go in North America if you're American or Canadian for cruises. It's just priced very competitively. And even the European cruises, I think, are priced relatively competitive for what you get, right? For what's included. I guess before we jump right to the numbers, I just want to show this. You can see that it was averaging between 40 and $60 for a long period of time. And then COVID happened. And basically, it had to issue a lot of debt. It had to issue convertible notes, which added to the fully diluted share count, and basically to survive. And the banks, I think, took advantage of the cruise lines. They charged them a lot of high interest rates and stuff like that and on favorable terms. And this debt acts like an anchor. And so while the business is technically putting up record numbers, and I mean record in every way, the valuation is still much lower, and that's a large part because of the debt. And so what I'm basically saying is, as they slowly chew through the debt, I believe this gap will close. And do I think that's a year from now? No, but I do think that's in the next 5 years. So that's something to point out, is just how I view this company. And the operations have been good. They have been pulling out costs, right? They had less than 1% inflation this year in their cost structure because they took out costs. Despite all the inflation we're still seeing in a lot of places. So this is really stark. So here you can see the last, I think I started with 5 years, but I added the 6 year because I wanted to see 2019. And the total revenue you can see just get destroyed during COVID, right? And then the bookings take time to get back up. So you can see 2022 did recover, but it's still a former which out of self. And then you can see 23 record numbers, 24 record numbers. And 25 is going to be record numbers as well. So anyway, another thing you can see is how little they were able to cut costs even during COVID. You can actually see both on the operating and on the SG&A. SG&A was largely sticky, so it was very hard for the cruise lines. Just imagine your revenue is going down, but you're still having to pay people, right? That's what happened, right? They were shut down, and all you saw were headlines like the Petri dish cruise lines, right, for coronavirus, right? And all the ports, some people wouldn't let them in, right? There's a lot of drama on cruise lines at that time, and they got killed. And you can see this in the numbers. Like, you used to make $1 billion, now you're losing $4 billion a year, right? That's the crazy swings that happened. And who paid for that? Well, both the equity holders through dilution, you can see that here, but also the debt load, which you can see here going from 6.8 to 12.4 to 13.6 to $14 billion. So you went from you almost doubled your debt load to make it through to the other side, which we're seeing now. And this acts as an anchor on the valuation, and it will mean revert around it. And as the company continues to perform and pay down the debt, you're going to see that as well. And you're also going to start seeing that in the interest expense, which is also going to start helping the margin because the interest rates weren't that great when they had to borrow, and the terms weren't that favorable. So anyway, you can see we're back to operating income profitability, but a large part of that is now going to the debt load, the interest expense. So the business model shifted. It's more levered than it was, even if in terms of the operation performance, it's better than it ever was. So it's something that people need to consider, and I feel it's not talked about. The balance sheet is not talked about enough on most YouTube channels. You can see the CFO start picking back up again, but you can see CapEx is also very high. And even during when the shutdowns, they still had payments for new builds, right? Non-negotiable, committed years in advance, right? They can't pull out of the new ships they're ordering because it's in the contract. So they still had to make these $1 billion CapEx spends on top of losing $4.5 billion in 2021, right? So these are huge losses for a market cap of a company that's only worth $9.5 billion. I mean, it used to be worth 12.4 pre-COVID. So you can see we're getting a material discount relative to here, even though the business has technically gone from 6.4 billion to 9.4 billion. It's just the debt load is so high, and the interest expense is eating a decent amount of the profitability. And there's dilution as well. You can see that here going from 255,000 shares outstanding to 515. Now, in terms of the latest quarter, we actually saw this go back down. They've actually refinanced, and they're actually going to reduce this fully diluted share count by a material amount, but they had to pay money to do that. So we're going to see, we actually saw, and that's one of the reasons why I'm doing the videos, the AI was fighting me on the interest expense, but we'll talk about that in a second. What else should we talk about? Capacity days are strong, occupancy strong, net yield strong, operating margins almost back to where it used to be, and EPS not quite back to where it used to be, but it's getting there. And a large part of that is the share count has gone up so much. In terms of the guidance for 2025, you can see doing about 210 in EPS, which is nice, and you're also seeing the weighted average shares outstanding go down to 467 million, which is a far cry from this 515. So that's a material decrease in the fully diluted share count, which is very exciting. We're going to go into some why that happened as well, because I thought the contract was interesting. I think the market misread it. And then you have the net debt leverage, so shooting up, right? You went from 7.8 times to 2.8 times to 7.5 times to 5.3, and now they're targeting mid-4 next year. So once this gets down to this 3x range, or perhaps less, I would expect the valuation to start re-rating. So I asked, I was casual. I'm like, why do you think the share price went down so much at the call, right? And basically just loaded everything bad about it. I said the interest expense actually increasing. It's getting better year over year. And AI was like, no, you're wrong. And it's like, for the 9 months, the net interest expense was this number, right? A substantial increase from the year before. And so I was like, AI, why do you think net interest expense went up 40% when the debt load went down? It couldn't answer it. And then I was like, did you read the 10K? Because it told you that they had a premium expense here, right here on this line, early redemption premium for the refinancing, which they have to book into interest expense. So that's why it shot up $240 million year over year, is because it's literally early redemption. And that's the bank's pound of flesh. They get paid no matter what. So basically, even with, say, like a mortgage, so most people have, there's only so much you can prepay. It's called prepayment risk. And if you prepay more, you have penalties. So you actually have to pay more to get out of debt quicker. And the same things happen for businesses like this. And I do think the banks really took advantage of the cruise line industry during COVID. But anyway, I digress. That's what it is. I just thought it was fun to share because I was fighting with the AI. I'm trying to train it to be better, right? Because when you're so cavalier about your language, it could be scary. Someone could just read it and agree with it, right? And you got to read it and be like, does that make sense? Like, and ask the AI harder questions, like drill down, like really debt went down and interest expense shot up 40% and you don't know why, but you just know that it's worse. Like, thanks, I know one number's worse than the other, right? Anyway, you can see the fully diluted share count start going back down finally, which is a difference in trend. And a lot of that is from the refinancing that they just did. In terms of the EBITDA, you can see the Q3 was actually very strong in terms of EBITDA. And a large part of that is because of these one-off charges, and the interest expense is also very high, right? Depreciation on new ships is also very high, which hurts, doesn't hurt EBITDA, but hurts earnings, right? So it's also worth pointing out here. And then I got it to correct itself. I was like, okay, now redo your work. And basically it said these figures are nearly identical, which strongly suggests underlying reoccurring interest expense is not increasing. The spike was driven by a one-time cost of actively managing the debt. So the debt, here's the transaction, but basically they're just refinancing and they're lowering the diluted share count expected. So that's all it's doing. But to do that, you had to incur a penalty basically to do so, to refinance at favorable terms, because the bank always gets their pound of flesh. So we kind of talked about it here, but this is the math behind it. If you want, you could freeze frame it really quick. And I asked, well, why would a company do this if the share price shoots down so much on the news, right? Because it didn't look good if you looked at just the superficial numbers like the AI did, right? It basically beat up Norwegian. I was like, okay, I got to buy it. I already had my mind made up, and I was just trying to ask it questions to see why. Try to understand the other side, right? Because the AI was very against Norwegian. When I started, it was like, don't do it. It's not running well. It's super levered. It was like, I've never seen so much fear in the AI language before. But anyway, by executing the deal, NCL's management has made a calculated multi-part decision. They signaled a strong belief that the stock price in the future would rise above the note's conversion price, right? So that's why they took it out, because it would limit the upside and lead to a lot of dilution later on, right? So spending money up front now will reduce the fully diluted share count later. That's another point to take. Here's the hotel industry, and here you can see just how much price they took. So this is the hotel, and you can see ADR barely going up in 2018 versus 2019, like $1, right? No big deal. And then all of a sudden you have 2020, so things collapse. However, hotels recovered a lot quicker than cruise lines did, right? Because cruise lines had a lot of negative marketing, and then the booking curve takes time to fill up anyway. So you had a lot of different things play out. But here you can see, after the decline in ADR, you can see they took a 20% price in 2021. Then they took another 20% price in 2022, right? So now instead of 130, 131, you're at 149. And then they took another 4% on top of that in 23. And then they took another 2% on top of that in 24, which is more in line with the traditional, but still higher than the spread that it was then, right? So you've gone from $131 a room on average to $159, and I bet you that number's low, especially in select markets where there's high tourism. I bet you the hotels have gouged a lot more price. The cruise lines, on the other hand, here the data wasn't like perfect, but you can see cruise lines reduced prices by 4% in 21, but they didn't have the number in 2020, right? So while the hotels raised prices by 20% to cover for COVID, in 21, the cruise lines were still decreasing price by 4.3. And then they started, 2022 was really just getting the booking curve, so they weren't going to take price until they actually had enough demand, right, to start taking price. And that finally started in 22. And then 2023, you saw the yields rose, so they took about 13% price. So you have negative, -4, and 13, right? And then 8 or 5, depending on the cruise line after the fact. So material less price taken than 20 and 20 and 4, right? Just the combined effect of that is materially higher. So what I'm trying to articulate is hotels took a lot more price than cruises did. And the data is not clear here, but they is decent enough at pulling out certain facts at specific points in time. So hotel industry owns price hikes 24 to 55% in key markets, create a massive opportunity. Cruise lines strategically held the base ticket prices at a significant discount to fill their ships, knowing they could capture profit via high margin onboard revenue streams. And you can see in terms of like the average cost per day, it's not that much more expensive when you include things like food, right? And entertainment, right? So this is a cruise line speed versus a hotel. And basically it's saying the hotel a la carte is $294 versus the mainline cruise for a frugal calendar, $213 per day, right? So you literally cheaper than a hotel, but you get to go around and travel the world and still get a similar, probably superior experience than just a hotel and maybe what's around it. But again, that depends on the traveler. But this is just rough ballpark, so I'm trying to show the valuation gap for the two. And so what I asked the AI was, okay, so compare the PE. Is it cheap relative to its long-term average? Look at the PE, but also look at the EV to EBITDA, because I wanted to get the debt in there, which shows up in the EV. Anyway, you can see the forward PE looks dirt cheap for Norwegian, right? You're under 7 times next year versus the pre-COVID average of almost 13.5 times earnings, right? So you're getting a multiple that's got cut in half, which is exciting, right? So 50% off. However, a reason why is because you can see the EV to EBITDA still very much in line with 2019. And this I'm trying to use to prove my point that the debt acts as kind of like an anchor point, and it needs to deal with the debt before this will move higher. And so it likely will. It's just how long does it take, right? So I look for setups like this where I see the business performing well, it's doing things I would do. It just had a rough hand during COVID, and it's still dealing with the problems today, right? It had to pay out almost $300 million in early redemption this year, right? Because of debt, unfavorable debt it had to take on during COVID, and unfavorable terms on the dilution side during COVID, right? So it's still paying for it today, and that's leaving an anchor point back to COVID. So that's why I wanted to do the video. I just think it's another opportunity that's still reverberating from what happened 5 years ago during COVID. And it might take 5 more years for it to show up, but I have a feeling it'll probably be a 2 or 3 year thing. Just as people get more comfortable with it, especially if I am right and the debt load goes down, interest expense really starts going back down, you're going to see even more leverage in the model, right? We're already seeing it on the operating side, but just on the debt leverage side with the interest expense, you're going to see it. Like the EBITDA is fine. It's just the earnings can also be charged by paying down the debt because the interest expense is relatively high. What else? In terms of the update, the company basically said record bookings in the third quarter, strong demand for Caribbean, optimal range for its forward 12-month booking, occupancy still 106, exceeding the guidance. They raised their full year EPS to 210 and earnings power from 205, so again, a beat and raise for the year. And honestly, my biggest uncertainty is oil because it's been low now for a while. It was easier to call to make last year, right? So it could put pressure on the margins if oil starts going up again. So I might start looking at some companies that are also super cheap on the oil side, right? Because oil's been kind of flat for years now, right? Maybe some nat gas plays like Tourmaline. Maybe look at Pay2 again. We haven't done a nat gas or energy play for a while, or Suncor or CNQ. But anyway, I digress a bit. I'm rambling. And I just thought his closing remarks, because I'm pretty sure they saw the share price as they were talking. And for those of you listening, for these who participated, particularly pleased with our record bookings, our record revenue, our record EBITDA, our record for future booking position, and all the wonderful tailwinds the brand is undertaking. This statement isn't exactly saying things are bad, right? So when the share price goes down 20% and is literally putting up record earnings, record revenue, record EBITDA, record forward booking, I'm like, okay, this is probably an opportunity, right? Man, it's just the debt load, keeping it low, and making it mean revert around it over time. So that's just my thinking. In terms of ownership, there are some companies that do own it. Kind of interesting. There's 2 that I respect, Ariel and Geode, and I see them now and then. They've also been adding to it. Ariel has it as a 9%, or its 9th ranking, so 3% position, which is pretty high. They own almost 3% of it, Norwegian. So there's a few funds in here that might be selling just because it's near year end, but most of those decisions would have already happened. But I mean, when you see something shoot down, you're like, oh, now I have a loss. I can maybe buy it back in a month. But overall, I was kind of surprised that the ranking was relatively high, right? And I can see the reason why. Just like, okay, I think you will be right. I just think it might take some time, right? And a lot of these guys actually upped their position size in terms of their weight relatively high, right? 7% position, 9% position. So more than I was expecting in terms of funds that own Norwegian Cruise Lines at this point in time. But most of them I have, like, none of them I don't really know what Golden Tree Asset or Columbus Hill is, but I have seen Ariel investments around before. We've overlapped on a few, which have been correct. So there is that as well, worth pointing out while we're here. But anyway, I'd like to know your thought on the cruise line. It's always interesting to see what the outcome will be in the long run. I'm gonna love to look at this video like 3 years out from now and be like, was I right or wrong, or maybe I was too clever on oil. I have no clue. But it'll be interesting to see if I'm right as the deleverage slowly goes down. The multiples should come up, right? Because the PE looks really cheap. So if they just continue operating, start paying down the debt with its cash flow, it's gonna start looking pretty, I think. Anyway, have a great rest of your weekend. I gotta go back to Halloween. Okay, bye.